we're going to do one more thing here, folks. Talk about politics and the economy. There's been a lot of discussion this week about the border adjustment tax proposal, call it the BAT, where importers get taxed 20%, exporters wouldn't be taxed at all. It is very complicated, but investors may be missing a bigger point. It raises a lot of revenue, nearly $1 trillion or more over 10 years. And why is that important? Because Republicans see it as a revenue source to help at least partly pay for all the other stuff that we're talking about here, like individual and corporate tax cuts and infrastructure spending. Without the money, those other ideas could be watered down. You could get opposition on the deficit. So the border adjustment tax or the BAT is critical for investors gauging whether other stimulus measures actually pass. And it's a big reason why some investors tell me the market may be ahead of itself in pricing in some of these other programs. Joining us now with more on this, Cato Institute Senior Fellow Dan Mitchell. Dan, thanks for joining us. Was this an idea that was a revenue source in search of a justification, in your opinion?
There's no question that it's there because it provides $1 trillion. I don't like the underlying idea, but I like what they're trying to do with the money, lower corporate rates, expensing, things like that.
So what happens? Somebody yesterday from another think tank said to me, this is the difference between the House plan costing $4 trillion versus $3 trillion. What happens if you can't get this trillion?
Well, something else has to be dialed back, or, heaven forbid, you actually have to slow down the growth of government spending, and you know they don't like doing that very much on Capitol Hill. But if you give up the $1 trillion of revenue from this border adjustment provision, maybe the corporate rate can't come down to 20 or 25 or 15, whatever the final number will be. Maybe you have to phase in expensing. You have to give up something. It's going to be a horse trade on Capitol Hill.
So I'm right in telling investors, I just want to be clear about this, watch the BAT in order to understand how big some of these other programs that they like can be.
I definitely think you have to keep your eye on that provision. But, of course, if you're talking to investors, they need to be looking at the fact that the whole justification for this plan is that there's going to be a big appreciation of the dollar. And that means, for instance, if you're looking at a company overseas that has a lot of dollar-denominated debt, that could be a real hit to them.
So, I mean, let's talk about that. Who pays this $1 trillion of tax if it actually is enacted, this border adjustment tax?
It would be a tax on everything that gets imported into America. Now, the supporters claim it's not protectionist because we'll have this big appreciation in the dollar. Now, if you believe that, and I think in general it would move in that direction, then you have to look at, as I just said, foreigners who hold a lot of dollar-denominated debt, because all of a sudden, if they earn money in local currencies and have to pay back a dollar that's worth 25% more, like Martin Feldstein said in the Wall Street Journal the other day, that makes their life very, very difficult.
So, I mean, these people claim it's, look, I have completely understand the math and the economics behind the appreciation of the dollar such that there's no increase at all in prices. You just don't think that's going to happen?
I think lots of things affect exchange rates, and you have pegged currencies, you have central bank interventions, you have all sorts of things that may swamp, may offset, may not offset. I mean, we don't know. All I know is that it strikes me as a bit mysterious that Republicans would put this in their plan when it creates civil war in the business community between importers and exporters. It runs the risk of the WTO rejecting it because it's clearly not compliant with the WTO rules about border adjustment only being for things like value-added taxes. So it probably does, as you said, undermine the chances of this good tax plan going through.
People can't get their brain around it. And I want to just do one more level of complication here. I know we got to go. But Peter Navarro and Wilbur Ross claim there's an imbalance, that you get to export to the United States for free because the VAT gets written off, and you pay a tax when you go into Mexico. You've argued they have the economics of this exactly wrong, that Mexican exporters don't compete with U.S. exporters. It's really the competition in the market. Explain your piece, by the way, where you agree with Paul Krugman on this.
Yeah, I don't agree with Paul Krugman a lot, but if a Mexican product comes into the United States, it is sold without a VAT, competing with American products sold without a VAT. If an American product gets exported to Mexico, it is hit by a VAT, but so are all the Mexican-produced products sold in Mexico. So a value-added tax, which, by the way, I think is a horrible idea, and one of the reasons I don't like this bat is that when the WTO rejects it, they might fix it by making it a VAT. But anyhow, there's no trade advantage, no change in the terms of trade by having a value-added tax inside your country. You're financing bigger and more wasteful government, but you're not distorting trade or getting an advantage on trade.
Dan, thanks so much for joining us this morning.
Thank you.
Dan Mitchell from the Cato Institute.